Good morning, I'm Robin Gibson, and this is your Harvard House Money Morsel. Welcome back to a rather chilly Howick. I'm sitting with Michael Porter, Chief Investment Officer of Harvard House. Michael, thanks for joining us again.
Morning.
We've seen a lot of volatility in the market, and I know that in the Intuition article for the first week of June, you've written a lot about how interest rates drive the ratings of share prices as a result of this thing called a capitalization rate. Michael, won't you just spend some time maybe unpacking that a little bit more for those of us who are not accounting inclined or investment inclined, please?
Sure. Good morning, everybody. It is cold this morning, second day of frost in Howick. So, Robin, I have a client who sends me articles from time to time. He shares them from UK newspapers. And a couple of months ago, there was an article in the Daily Telegraph that basically referenced back to an article that Warren Buffett wrote back in the late 1990s. Just to put that in context, so he was basically saying that from 1965 to 1981, the US economy grew by 400% over that time. The economy grew, companies grew their profits, and yet the market went sideways over that whole period, went sideways for that 15, 16-year period. I said, what explains that anomaly? And basically it was because the interest rates on 10-year bonds went from 4% to 17% over that same period.
Goodness.
And he basically said that interest rates behave on financial stocks the same way that gravity acts on matter. It's a downward pull. So the higher the rate, the greater the downward pressure on interest rates. And so basically what he means by that is that interest rates have an impact in two ways on shares. The first is that if you're going to get 4, 5, 6% on your risk-free rate, your government bond, then actually all other asset classes, especially shares, have to do much better than that to make them attractive. So as your interest rate goes up, the opportunity or the return that you demand from other assets goes up, because you can get 6% in the bank or 6% on a bond. Now I actually need 8% from equities just to make the risk worthwhile. That's the first thing. The second thing is that the way we value shares, the way that anybody values shares, is that essentially the value is the present value of all the future cash flows. So if you think about a share and you think you're going to hold a share for 10 years, you're going to take all the expected cash flows from that share, all the dividends that you might receive over that lifetime, and the terminal value, what you might sell it for. And then you have to discount it back to the present to get a value in today's money of what you think that share is worth. Now, as the interest rate goes up, that capitalization rate goes up, and so the value of those future cash flows comes down. And essentially, if the value of those future cash flows comes down, then your share price comes down along with it.
So, Michael, and this speaks to really the Harvard House investment philosophy, there can be a massive disconnect in terms of the moving of the share price and the dividends that you collect while that volatility is happening. Is that correct?
Absolutely. I mean, the dividend has got actually very little, in some ways, to do with the share price. So yeah. I mean, Robin, if you just look at May alone, the market was down 8% at one point during the month. It closed flat. So there's massive volatility around at the moment. But the dividend really speaks to the robustness of the cash flows of the company and the cash generation, whereas the share price is a much more emotional thing which moves every day depending on the headlines and what's going on, and whether you wake up on the wrong side of bed in the morning, quite honestly. Whereas the dividends are based on the cash flows. The cash flows is based on actually how the company is performing and operating. So dividends are much more secure, much more stable. So yes, when you looking in the future and you're discounting back the dividends, it's not that the dividends are changing, it's just that the interest rate is changing.
So the message continues to be, continue to hold your shares. Do not be concerned too much about volatility. We're collecting your dividends, which is paying your income. And that's a great investment philosophy to move forward with. Michael, thank you for your time. Thank you for joining us. Don't forget to like and subscribe. Click the bell so that you can get notifications of when we release a new video. And thank you for joining us.